The following presentation is brought to you as a courtesy from Forex Academy. This is part of our service Advanced Technical Analysis course. If you find it interesting and wish to be updated on new releases, please subscribe to our YouTube channel or join our community at forex.academy and receive all our services for free. Your like is also highly appreciated. Enjoy.
So we come back to the same chart that we looked at earlier. And you can see that we've included in the lower portion a relative strength index. What we've also done in this particular chart is we've highlighted certain instances where the momentum oscillator is overbought. Rather, oversold, my apologies, because the trend is up. Therefore, we want to be in a position when we go long with momentum rising, as hopefully price would be doing as well. We've concluded from earlier discussions that the trend is clearly up. We have a sequence of higher highs and higher lows, and we have a positive sloping moving average. The idea then would be to see whether buying opportunities are a viable option when the momentum oscillator is oversold. In other words, what we are saying is at whatever price level exists at the point where the momentum oscillator moves below 30%, that price level is your cue to consider a long position. First observation that we need to make is to identify these various oversold levels, as we have in this chart, and to see what happens with price action once the market begins to unwind the oversold condition. We can see that in this case, certainly prices continue for a short period to move lower, but they then result in a move higher. In this instance, from an oversold condition, price action continues to, or resumes rather, the uptrend by extending the move higher. Likewise, at this point, yes, there is perhaps a little bit more of an increase in volatility with some choppy price action, but ultimately the market begins to recover. In this instance, from an oversold condition, once again, the market begins to recover. We see this occur on this instance to a lesser degree. Market then subsequently sells off, and at this point in time, with the slope of the moving average still positive, the market once again begins to recover. So, as a first test of this logic, we can draw the conclusion that there is some information behind the direction of the trend and oversold readings in momentum. And perhaps this also then can be extended into using this information from a trading perspective. So what we're essentially looking to do is to say to ourselves, when the relative strength index moves below 30, the price level that exists in conjunction with that move below 30 in the RSI represents our buying opportunity. As we need to identify with every single trade before we can actually execute a long position, we need to establish our risk parameter. And the risk parameter is important because we're able to firstly establish how much risk we're taking on board, whether it'll be too much or acceptable, and also whether the risk reward opportunity is attractive given where we think the market is likely to travel to. So on each buying opportunity that we have, and we can come to the conclusion that every area that has been circled represents a buying opportunity, we need to identify where our key risk level is. And the key risk level will simply be calculated around your key support levels. So If we were to buy around this area, then we would have to recognize the fact that the low down here is our key risk parameter. In other words, the consideration would be that the initial stop loss would sit below this low over here. If we were looking to buy at this opportunity, then the key risk parameter would relate to the most recent corrective low, which is this level over here. That is where your stop loss level would be placed. Likewise, on this pullback, you would have to at least consider this as a relevant point. In this instance, it certainly lies significantly far away from price action. We may need to consider using alternative methodologies if indeed we are looking to go long at this point in time to establish where we will place our risk. We also notice that for prices to move all the way back down to these lows, we will also have traded below, significantly below where the moving average lies. In this particular opportunity, we can use the most recent corrective lows as our risk parameter. Likewise over here, and certainly for this point for this opportunity at this stage. So support levels are very important in terms of being able to identify them because they facilitate your risk management. What we can conclude from the discussion on this particular slide is we have found a means in which we can firstly establish the directional bias by looking at the sequence or the relationship of the sequence between highs and lows, and also applying a slope of a moving average. When the two are in agreement, we have a defined trend. We can then use either overbought or oversold readings, depending on the direction of the trend, to identify when to take a trading decision. One final point that I would like to add is, let's assume that you made a decision to go long at this point, and you decided that it was acceptable for you to place your stop loss at this level over here. As price action moves higher, you continue to observe the developments of the underlying trend. When price finds support at this level, we then start to see a recovery, as we have seen on this particular low, and the market starts to move and break above the prior trend high. Once the market has broken above the prior trend highs, you can then move your critical risk parameter from the original position to the new level. In other words, once you've broken to new highs, your stop loss can be placed at this point. Once the market moves to new highs, we can adjust the stop loss higher to this particular support level down here. And again, after this extended period of consolidation, as the market moves higher, we can place our stop loss below the most recent corrective lows. As the market moves higher, it finds resistance, corrects down to this point, and then starts to travel higher again, generating a new high. We can then move our stop loss up to this particular point. Likewise, with respect to this pullback, the stop loss will be shifted higher to that point. And you can see that eventually the trade would have been stopped out on this pullback over here. This is an illustration of how the use of these concepts that we're looking at today can help facilitate you managing a more objective overview of the market. And this is really the one challenge that we all face, even as experienced traders, is remaining objective in the marketplace. Our subjectivity can certainly cause us to make some irrational decisions at various stages. If you simply say to yourself, the trend is up because the sequence of higher highs and higher lows remains intact, as well as the positive slope of the moving average that I can observe, therefore I want to maintain this long position. I will allow the market to pull back because corrections are healthy for an uptrend, and every time the market has defined a key support level, I will move my stop loss higher and trail the position for as long as this trend remains intact. This is a very disciplined approach in terms of concepts that we've just looked at in terms of applying your risk management to your trading strategies. Running or allowing your emotions to get the better of you may force you to perhaps close the position at this point because what you're concerned about is giving away too much P&L, only to then see the market start to move higher, and it then makes it equally more difficult to get back into that particular position. Now, I appreciate the fact that we're looking at a very long-term chart in the Dow Jones Industrial Average, but this really just simply highlights a trend component. The concepts can be applied in exactly the same way, even if you were looking at an intraday chart, whether that intraday chart is a 60-minute chart, a 4-hourly chart, or even a 5-minute chart. Obviously, the trends are for smaller periods of time, as well as smaller ranges in price, but a trend at the end of the day is a trend and can be monitored and applied and managed in the exact way that we've just considered. Let's just extend our discussion and our focus on risk management. As we've just shown in the previous example, a very simple and easy technique to apply is to use the corrective highs and lows as your risk parameter. Being able to identify your support and resistance levels helps facilitate where you can place your stop loss levels. In an uptrend, remember that the corrective lows determine where your stop loss sits. In a downtrend, it's the opposite. The corrective highs determine where you place your stop loss. This technique, therefore, also closely follows the key definition of a trend. And we're applying this to help facilitate our effective management of risk. So we're using trend definition components to extend that into our risk management overview. Always look to apply the trend when applying your risk management approach. So if we come back to the illustration that we've been following over the course of this webinar, and we now have a complete scope of information which allows us to define our trend, allows us to identify when, remember timing is important, when we can execute our long positions, and then also use all of this information to identify where the key support levels are and therefore the key risk parameters. Therefore, from a risk management perspective, we are using previous lows, in other words, the support levels, as our reference points to manage both the trend condition and our position. If we just look at the most recent activity and we extend all of the points that we've discussed thus far, we can see that the slope of the moving average is now at least showing some early signs of identifying a more negative slope. We've seen price action move higher to find resistance at this particular level here. The question that we need to ask ourselves is whether price action will travel further to confirm a break of this resistance area. If not, and we subsequently see a move to the downside below this particular low, then we are clearly dealing with a downtrend. If, on the other hand, and every trader's personality is different, you are a more aggressive trader, you like the concepts that we've just been discussing around the slope of the moving average, and you feel that this move higher offers an early opportunity to go short in what you believe is a developing downtrend. You've matched some key elements in terms of the timing and in terms of the direction. You have a negative slope in moving average. Your momentum oscillator has moved into overbought territory. Price action continues to remain below the most recent trend highs. Therefore, that represents your key risk parameter, and that will then equal where you place your initial stop loss on this particular position. Therefore, you may come to the conclusion that it is worth, in your opinion, to execute a long position in this area, or rather a short position in this area, against your risk parameter, which is where you'll place your stop loss. If you are correct, as a minimum, your expectations will be that the market will travel down to this particular low, but there is also a greater chance as prices move lower that we'll see a break of that particular low there. Therefore, that setup, you may come to the conclusion, offers you a very attractive risk-reward opportunity to go short. So what we've seen by this illustration is how we can then also take the components that we've looked at and identify at a relatively early stage a possible change in the direction of the trend, which would then equate to a change, if you are correct, in market sentiment. In this chart in front of you, we can see a number of cycles in the chart. We have a bull phase, we have a bear phase, and the question currently is whether we are currently dealing with the bull phase. So let's run through how we would manage each of the various phases. We can clearly see that at this particular low over here, the slope of the moving average is positive. Therefore, given the fact that the slope of the moving average is positive, there should be a higher probability that the market will eventually move in an upward direction. We also identify that this pullback has seen the momentum oscillator move to oversold territory. Now, you might be asking yourself a question at this stage as to why the oversold and the overbought regions reflect 40 and 60% respectively. When using the RSI, the default readings for overbought and oversold are 70 for overbought, 30% for oversold. However, you may apply your analysis to a particular instrument, and you may see that it's very seldom using a 14-day period that you have the relative strength index either moving above 70% or below 30%. And let's assume that you're using the default period of 14. You have two options when you see this. One is to perhaps reduce the period N that you're using, i.e. from 14 perhaps down to 9 as a consideration, or you can make an adjustment to the overbought and the oversold region. Now, it is quite common practice within the market to use a relationship between 60 and 40. We're not suggesting that you tighten the bands even further by perhaps using 55 and 45. Generally speaking, we're using two options, 60 and 40. You may, on occasion, if markets are extremely volatile, decide that you might even want to widen the bands from 80 to 20. This is very rare. I must be honest with you, in my experience, I've never had to consider doing this. 70 and 30 for the relative strength index is an ample and a very adequate starting point. However, you may consider using an alternative 60 and 40 so that at least you get overbought and oversold readings. We're not looking at changing the logic of the application. We're simply changing some of the parameters that make up that particular indicator. So in this instance, we can see that the indicator is below 40% and very clearly prices have moved higher. In other words, if you had bought down at this low or on this pullback, you would have made or generated a very decent return. The one difficulty perhaps with this particular decision at this stage is, where do I place my stop loss? It might have to be down here. You may come to the conclusion that it's too far. One alternative approach then to say to yourself, okay, I still want to participate in a recovery in price action because I feel that it is a good opportunity. If you are unable to establish a decent trade at these lows, you always have a contingency plan which would mean trading the breakout. If you buy on the break of this high, you are doing two things. You're trading in the direction of the trend, because the market is already moving in that direction. You'll appreciate the fact that buying the pullback is, to a degree, trading against the current or the most recent direction of price, which has been down. In this instance, you're simply buying as the market is rising. What that allows you then to do is to place your stop loss below the most recent corrective low. So you have a clearly identified risk parameter against which you could make your trading decision. We see the market travel up to these highs, some consolidation and a pullback. The market is once again oversold, and that provides us with an opportunity to go long. The market then just marginally breaks to new highs. We see a subsequent pullback again to oversold territory, and the market then travels higher. So clearly, this relationship between the oversold readings in your momentum oscillator against the backdrop of a rising market is providing us with very effective and very clearly defined buying opportunities, importantly, not just in terms of the level, but also in terms of when to make that decision. If we then follow what happens with price action, things begin to move sideways. The slope of the moving average begins to take on perhaps a more negative slope. Therefore, that could be a warning sign that price action is beginning to highlight a more bearish trend, or that market sentiment is establishing a more bearish outlook. We can clearly see that the pullback from this low up to that high has failed to generate a new trend high above the most recent trend high, and instead the market moves lower. We can see as well that from this stage, the overbought reading in price action effectively identifies where the market stalls and then resumes a downtrend. Once we break through this low, we can say to ourselves, okay, we are now dealing with a clear downtrend. We have a sequence of lower lows and lower highs. We have a negative sloping moving average. I am going to sell when the market is overbought. And you can see this particular opportunity that would have provided you with an opportunity to sell, placing your stop loss above the most recent corrective high. Equally, where the market travels up to this particular area over here, that reflects or represents another opportunity to consider a short position. The market pulls back, another overbought reading in your momentum oscillator, and we see prices move lower. That, however, forms part of a more consolidative phase where the trend direction begins to change. So you can see how we are simply using these conditions to identify what market condition we are dealing with. And once we've effectively identified that market condition that we're dealing with, that then provides us with the cue as to what trading signals we will be looking at. Then we can then focus our attention on the momentum oscillator and look at establishing either buying or selling opportunities based on the direction that we perceive the trend to be moving in. So to look at the last option that we have available to us in terms of the information that we have in front of us, we can see the market is clearly trending up. This is defined not just by a sequence of higher highs and higher lows, but also by a positive sloping moving average. That means we are looking to go long this particular market. We notice that resistance has been identified at this particular level, which has forced prices to move in a downward direction. Prices have moved down towards the moving average, and we can see that we have traveled to oversold territory in this particular momentum oscillator. Therefore, because it is in an uptrend, we are looking to buy, and our preference would be to buy when the market is oversold. Therefore, at current levels, this should represent an opportunity to go long. We would obviously need to establish where our risk parameter lies. We have an indication as to where we expect the market is likely to move towards. If it does start to recover, as is our expectation, then as a minimum, our target will be the last trend high and potentially even higher. So this level then can convert into an objective or a take profit level or even an initial target with respect to managing your risk reward potential on that trade. If for whatever reason you had perhaps established a long on this breakout and your stop loss was placed there, given that you're still currently long, you're saying to yourself, I'm happy to be long on this particular position because the market, in my opinion, is still likely to move in an upward direction. I'll live through this pullback, but the fact that we have now pulled back where the market is oversold and even pulled back to the moving average, you will be looking for signs that would suggest the market is likely to move higher. And that would be the way you would apply this information in terms of managing the trend. Your expectation now, if these signals are correct, and I am correct in terms of my evaluation of the trend, my expectation is that markets will now start to move in an upward direction. By coming to that conclusion, you're able to then manage whether things begin to derail or begin to go wrong with respect to your evaluation of the trend. You can then also, certainly if the market moves higher, move and adjust your stop loss accordingly. So you are able, by applying these techniques, to increase the chances of you maintaining an objective overview of the market. I'm not going to say that you will always remove your subjective elements or the subjective issues that we all face. The challenge by taking a subject like technical analysis on board is so that it can also contribute towards you managing events in the marketplace in a more objective manner. In today's webinar, we talked a lot about the trend and how to trade the trend. We started off by just recapping on some key considerations relating to the trend, understanding the trend, the very important element that the trend is always your friend and treat the trend this way. We revisited the concept of defining the trend through the slope of a moving average, and then looked at using all this information to improve our timing element by incorporating a momentum indicator. All along, in terms of the discussion, there was a continued reference and a referral back to the relative importance of risk management. We showed how both timing a trade and managing risk is very important. The applications that we applied hopefully have illustrated the tools that we've looked at today in terms of how you can put these concepts together to develop a very disciplined approach to trading and also increase the chances of you being able to manage market activity in a much more objective manner. If we can remain objective, we can make better decisions as traders. In tomorrow's webinar will be workshop number 2. We will simply apply the ideas of illustrating how you can incorporate technical analysis into a solid trading plan, hopefully then also contribute to you developing robust skills that are necessary to read market conditions. And we'll end off tomorrow's discussion with some final considerations around the topics that we have discussed. Congratulations, everybody. You have now completed webinar 7 of the Advanced Technical Analysis course, as always. Thanks very much for joining. Today's topic was all about trading the trend. We'll be back tomorrow. Hopefully you can join us then. See you next time. Bye for now.